Hello and welcome everyone once again to our latest SB Talks podcast. Today is Tuesday, December 6th, and I'm once again joined by our Chief Investment Officer, Ashley Owen. Today we'll be talking about inflation, interest rates, valuations, and the market outlook. Welcome Ashley and welcome everyone.
Hello wherever you are in the world. Welcome to RBA Rate Hike Day number 8.
Now, Ashley, as you've just called out, today is the first Tuesday of the month, and it's worth pointing out that we are recording in the morning time, so we haven't yet heard the RBA announcement, but everybody is pretty much locking in another 25 basis points today. Do you see any other possible outcomes in that one?
The answer is it actually has nothing to do with inflation or the economy or growth or unemployment. What Philip Lowe does is pretty much trying to save his reputation as an RBA governor. So I think 25 points being a sort of a modest hike is the only thing he can do. Bear in mind that inflation jumped to 40-year highs prior to Russia, so don't blame nothing to do with Russia. Russia was the icing on the cake.
It was already coming.
Inflation is caused by too much money chasing a fixed amount of goods and services. Too much money comes from governments and money printing and free money from banks and the RBA's free lending programs. That's where the money came from. Russia took out supply and some commodities halfway through that, but inflation was already running at 40-year highs prior to Russia. So now the important thing is that we talk about this, and the reason we talk about it is because everyone knows that, except central bankers. And the fate of the world share markets is based on how much they understand the problem and the causes of the problem, and therefore some of the solutions. Now, a year ago, the Fed, Jay Powell did mea culpa. I was wrong.
Yep.
Got it wrong. We completely got it wrong. Have to start raising rates quickly.
Started changing the messaging and the expectations heavily at that stage. Well,
took Phil Lowe a year to make the same statement, but he didn't make the same statement about the 28th of November last week at the Senate hearing. He said, bear in mind that going back a couple of years, he was saying that we're not going to raise rates for 3 years. Everybody, take your money out.
April 2024 was still the...
Take your money out of the bank. We're not going to pay you any interest on it for 3 years. Invest in risky assets. So they did. They invested in Bitcoin and bought houses off the plan and all sorts of funny stuff and geared themselves to the hilt, which they were told to do because the RBA said, we are not going to raise rates for 3 years. Get your money out of the bank. Go and spend it. Go and invest. Go and borrow.
Which was ludicrous, essentially.
It was ludicrous at the time. So the first thing, what they did and what they said at the time...
And even the markets at the time, it was around this time last year that the market started to call it out. And
that's right.
And the bond market started to revolt against that 3-year number.
Investors knew all that, so they started to bid down the prices of bonds, and the bond yields rose, etc. Meanwhile, the RBA kept saying, we're not going to raise rates for 3 years. Don't bother putting any money in the bank. Take it out, go and borrow, gear to the hilt and buy stuff. And they did. Last week at the Senate inquiry, he didn't say what a year ago Fed Jay Powell said. Look, we were wrong, got it wrong, sorry, got back on business, back on track. Philip Lowe said to the Senate committee on last Thursday, he said, and a direct quote was, I'm sorry people believed what we'd said. So he didn't say, I'm sorry what we did or what we said. He said, I'm sorry people actually took us seriously and took the money out of the bank and went and spent it. Just crazy stuff. So what he does today is all about trying... Meanwhile, there's 100 different inquiries about whether they should sack him or burn him at the stake or whatever. So his reputation's at stake. So he'll serve out his term most likely.
You're sort of saying he's doing today what he has to do, which is 25 basis points.
Yes, he can't accelerate again.
Having already softened in the last couple of
nor can he
hikes.
Pause.
Yeah.
So he's got to really just do what he did last month and do a sort of 50 basis point, or 25 basis point to slow it down. On top of all that, to their credit, we bag central bankers. It's easy to do. But to their credit, they've got to try and make decisions by looking at data, and the data takes a while to filter through. So when they raise interest rates or cut interest rates or do something, it takes quite a long time for that to be filtered through into people's spending habits and behaviours. So, and that takes a while for that to be measured and reported in the numbers. So all of it takes 6 months to do. So they're still trying to assess the impact of the rate hike 6 months ago.
Yes.
So to their credit, they've got to really, they don't want to put the brakes on again or go too hard or too soft, because if they're still waiting to see what happened to the last, there have been 7 rate hikes in Australia. People are still got money in the bank. It's not really hurting spending yet.
Yeah. It's realistically only September, October that the rate increases that have already been done are starting to be felt by households and by investors.
So one thing I spent a bit of time on in the monthly report this time was to look at the actual amount of money in Australia. There's about $2.8 trillion of money. When we say money, we mean cash, coins and notes, and we mean bank deposits, term deposits and time and demand deposits, which is check accounts, transaction accounts. Now the sum of all that was a bit over 2 trillion pre-COVID. Given all the free money dished out by governments and central banks, that $2.1 trillion pre-COVID 2 years ago is now, nearly 3 years ago, is now 2.8 trillion. So there's 28% more cash in the system we're still sitting on and spending. So that, for the first time in about 3 years, that rate of household spending, retail spending, has started to slow a fraction, a couple of percent down over the last couple of months. So Australians are still sitting on a mountain of cash that they still have ready to spend if they want to. So, and
likewise, investors potentially got plenty of dry powder there to deploy should things get worse.
They have. The numbers are extraordinary. The average household, and now this is not the median. The median's got bugger all, but the average, which is including all the wealthy people, the average household is sitting on $280,000 worth of cash. 10,000. The average household, there's 10.1 million households in Australia. The average household is sitting on $10,000 in notes and coins under their bed, in their pockets, in their wallets, or in the bank safes. And in addition to that, there's another $260,000 of deposits in banks that the average household owns. Now, that's a massive mountain of money that they can spend. That'll be
very skewed, though, at the top end. Yeah.
So what we're watching is household spending, and that is only now just starting to slow.
Which is quite interesting, because the Westpac survey of consumer confidence basically went below GFC lows in its recent update.
So people are now slowly, but only just now, starting to tighten their belts in the knowledge that their interest rate. Now, bear in mind, we're talking about mortgage borrowers. Now, of all the 10 million households in Australia, 1/3 are rents. Yeah. So that they're not worried about that. They're worried about rents, which are going up for other reasons. 1/3 are owned outright, which is all of our clients own their house outright, so we're not worried about rate hikes. But only 1/3 of borrowers, households, are owned by borrowers.
Yeah, but one of the things Ian McFarlane did run through in our last podcast, which is quite interesting, is you have to add on top of that all the people, the investors out there. Yep. So, and what will be really, I guess, interesting, or a reality next year, is the huge volume of fixed rate mortgages that will be rolling off. So lots of people out there took great advantage of the phenomenally low interest rates that were on offer the last few years to fix for 2-3 years, and they are starting to roll off in very significant volume next year.
That'll be a big shock to spending, but again, it'll only affect a very small number of people.
A component of that third.
So Australia's an unusual market where everywhere else in the world, home mortgages are primarily fixed rate. In America, 90% of home mortgages are fixed rate. In Canada, 80%.
And in the US, very long-term mortgages
and as well. And they're 30-year mortgage rates, so the mortgage rates, their mortgage payments started to rise in the middle of 2020, which is more than 2 years ago now. So that's been a very slow, steady rise, and it's been flat for the last 3-4 months. In every other country, including New Zealand, Canada, America, all of Europe, the vast majority of their mortgages are fixed rates tied to long-term rates, and that's the legacy of the FDR era in the 1930s, when they tried to make housing a more safe investment. In Australia, vast majority of our mortgages have traditionally been floating rate, so therefore. They're much more sensitive to cash rate rises, which flow straight through within hours. Every bank raises the rates when cash rates rise. So it's very sensitive to rate rises, unlike the rest of the world. So the RBA has gone slow and late with rate hikes, partly because it's far more powerful in Australia to slow spending, and we're seeing that now.
Well, the levels of household debt are higher, and this has a more instant impact.
Correct. So as you rightly point out, in the free money bonanza, in the post-COVID era, during the COVID stimulus boom, about 40% of all home loans were enticed to go out and borrow, a la the the RBA's instructions, were fixed rate and at very low fixed rates, an average around about 2% fixed for 1 or 2 or 3 years, and they are falling due over the next 12 months, as you say. So you're going to have this, even though they are coming off fixed to floating, they're coming off at 2-ish type interest rates to 5 and 6-ish type interest rates to refinance. That'll hurt a lot of people who overgeared, took the RBA's advice and overgeared, bought flats off the plan, subdivided properties, got into construction loans. So a lot of those will be painful refinances when they occur, and you'll start to see a lot of defaults, and that will also push prices down more. Not across the board, but I suspect in the overgeared parts of particularly Brisbane, out of Sydney, out of Melbourne, they'll start to suffer more than
where you also have much more significant supply coming into the market on those areas.
Yep.
So the last couple of months, October, November, we've almost had a little bit of a relief on equity markets. You talk about it in your latest monthly paper, the soft landing rally, the celebration of the 7.7% inflation. Let's all
that's right.
Let's all celebrate. Christmas is back on again.
US shares jumped 5.5-6% in one day when the US inflation numbers came in at only 7.7, and the core inflation, which excludes food and fuel, came in at 6.3%. So it's not about Russia. It's about this is excluding food and fuel. It's still 6.3% in the US, which is seen as great news. So the share market jumped. So we've had share markets have come off around the world around about 15% plus another 2% last night, which is a moderate sell-off. Share markets globally, again, don't forget, are dominated by American tech stocks. The top 10 stocks in the world are all American, and most of those are the big Facebooks and Apples and Googles and Teslas, which are all horribly overpriced still. So the US, which is the global market, is still probably halfway from vastly overpriced last year, halfway down to fair. So we're still, Apple, Microsoft are still trading on price-earnings ratios of 25 to 30. Amazon is cheap at 95 PER, price earnings ratio, which is under 100, which is good.
Cheapest it's been in a long time. Yep.
Facebook 60 odd. So we're still talking about very high pricing for the US tech sector, which dominates the world. And for that reason, global share market is still probably only halfway down from bubble price last year to fair price. So we've still got a way to fall before they become fair. The rest of the world market, including Australia, are pretty much on fair price. Prices have come down less because we had less of a bubble. So currently share markets, they fell heavily during the particularly first half of the year. They've come back up 10-15% in the last 2 months because of this Fed pivot.
Yeah, let's talk about that a little bit, because you've named some of the technology stocks there, and their prices have continued to, I guess, struggle given the valuations that they have. But other sectors have shown a bit more resilience or recovery. Yes, the consumer discretionary, for example, with inflation, hopes of it not being as bad as it was.
Discretionary stocks, spending stocks, which are loose change for people. They go out and when they feel good, they spend money as against food they've got to buy to eat. Discretionary spending stocks and other cyclicals like banks, miners have done well in the last 2 months because of this idea of a rebound in the economy. So the world is now pricing in, the share market's pricing in a soft landing. And that's based on two ideas. One is either the Fed doesn't have to raise rates too far because inflation solves itself and magically returns to 2%. That's fairyland stuff. Or more likely the Fed is too scared to do a Volcker and take rates up to cause deep, serious recessions, widespread bankruptcies, foreclosures all over America. Either of those two scenarios, the Fed doesn't need to raise rates or the Fed hasn't got the stomach to raise rates, will result in a return to boom time pricing, and people will say, well, rate hikes, we'll get 1 or 2 more slow rate hikes, and then we're back to the boom. That just puts off the problem until a year or two down the track. The bond market, on the other hand, which is bigger and deeper and older and larger than the share market globally, a bond market is pricing in deep recessions. So the bond markets, US bonds, 10-year bonds went to 4.2 or 3% a month and a half ago. they've come down to about 3.5%. Bond markets around the world, yields have come down about 1%, which is quite a big move for bond markets over the last 2 months, based on the idea that we're going to have this deep recession next year. So you've got the bond markets,
and credit spreads remain elevated as well, which is indicating again concerns around.
Yes, right. So credit spreads, particularly high yield spreads, emerging market spreads, have blown out, not to crisis levels yet, but they are pointing towards more of a slowdown. So you've got about $80 trillion in the world share markets that are priced to assume a return to the good times, i.e. soft landing, shallow recession next year, then back to party time. The bond market, which is another $80 trillion worth of money, the weight of money is pointing to quite a deep global and US recession next year. Now, both of those can't be right. So in the last couple of months, we had a situation like July where shares did well and bonds did well because bonds started to price in recession and shares started to price in no recession. So it's one of those months where neither of those two can last for long.
You know that's not a sustainable trajectory. Yeah.
No, so you've got this, and of course in portfolios we have diversified portfolios. We have a lot of shares in portfolios, and we have a lot of floating rate bonds. We have very few fixed rate bonds, and the fixed rate bonds are the ones that are in trouble, having their worst years since literally in a century, because we've ended this disinflation phase from the last 40 years. We're now into an inflation phase. So bond yields have fallen dramatically over 30 years. They've spiked heavily over the last year. So bonds are in big loss territory. Bonds have recovered in the last couple of months because they're factoring in a recession. Personally, I can't see inflation in the US, and we'll deal with other countries in a second, but the US is the global key. I can't see inflation returning nice and neatly to target 1 or 2% range within a year. And that's what the bond market's assuming. I can't see that happening.
And we will have another, I think it's this week, is it? The Fed meets again, I think the back end of this week. Or
Fed meets middle of the month for their last meeting this year, then they don't meet until February. Most likely they've done a series of 75 basis point rises, which have been a very aggressive rate hike cycle.
So they're now about 1% above us, target range of 3.75 to 4.
Correct. So they've hit their daily, their overnight sort of Fed rate is at the moment about 3.8-ish%. Ours is 2.8-ish%, so they're 1% in front of us. But again, we've got a much more powerful lever in our floating rate mortgages, so that's not a bad thing. The Fed will most likely, again, this is what you're seeing every day or every night we watch the US market, and it's either the Fed's going to slow or the Fed's going to re-hike. And last night was one of those ones that said, well, maybe this pivot's out of play. So everything fell 2% last night, but it may well jump 2% next day. Most likely the Fed is, the point I'm making in our monthly story is that we've seen most of the inflation problem past. Inflation's coming down, a whole lot of reasons. Oil prices have fallen, therefore they're flowing through to pump prices. So some of these temporary aspects are rolling off. A lot of the closures and the supply constraints and the COVID closures in ports around the world, a lot of those will be eased in time. So we've seen we're not going to get 15% inflation. In Europe, we've already got 10+%. In the UK, we've already got 10+, but that's not a trajectory that's going to go up. We've seen the worst of the inflation.
Yeah, unfortunately, Europe will have a pretty ugly winter, and then hopefully
that's right.
Rises.
Secondly, we've seen we've seen most of the rate hikes. So we're not going to get another 7 rate hikes here. We're not going to get another 8 rate hikes.
So the US has gone from 0 to essentially 4 from about March this year, so slightly earlier than
So
Australia.
Probably we'll see another 2 or 3 rate hikes from the US in the first half of this year.
Next year, or I guess we've got one coming, and then they'll certainly hike, no doubt, further this month.
Probably, yes.
And then we'll see how.
Now that's even though we've only got maybe 2 or 3 rate hikes to go, and albeit slower, more smooth rate hikes or lower rate hikes,
more incremental.
That's not an argument for US shares to be priced where they are. They're still expensive based on post-GFC free money era cost of capital. We've got to get used to the idea where cash rates are going to be 4 or 5%, which I've been saying for years. They're going to be people are now believing it. We're going to see cash rates around the world, in Australia, US, like they were pre-GFC, around about 4 or 5% for your neutral cash rate. That means that all of the capital assets in the world, housing, commercial real estate, shares, property, all of that will have to be repriced back to normal 4 or 5% cash rates, not 0% cash rates post-GFC. So global shares have come down a part of the way. They're not yet fair, and they're certainly not yet fair based on a cost of capital on a normal 5 or 6%.
But you can probably differentiate sector to sector at this point, and the technology sector, which had run most heavily and had probably the biggest inflationary impact from the low interest rates, probably has still further to go.
That's right. So banks are cheap around the world. Industrial companies are cheap. Manufacturing companies are cheap. So they are more or less fair value based on the idea of a slower world, a slowing China, slower demand.
And let's be honest, this pretty simply, if you've got high inflation and the central banks are doing their job, their very fundamental job is to slow the economy and meaningfully to actually bring, that's the only way to bring inflation under control. So you can't have the economy continue to charge ahead and inflation be brought under control. It, by very nature, has to be slowed.
That's right. So you've got fiscal policy, which is governments.
Yeah.
They're elected, they're accountable, and they basically are very fickle based on what they workshop every morning in their focus groups, and they are terrified of losing votes. So governments are not going to raise taxes and cut spending because they'll get kicked out of office. It's left to central banks to try and rein in spending, and that's what they're doing via rate hikes. So the midterm election in the US was not a bad thing, in that now we have a divided Congress, so that will perhaps put a brake on the Biden spending spree, which is inflationary. So that's good for markets. We saw that we saw markets bounce on the midterms in the first week of November because they saw that less inflationary impact out of the White House, which is good. But short of that, in Australia we've got the government leading up to its May budget. We had a mini budget which meant nothing in November, but we've got May budget coming. And they did lay the groundwork for some probably quite serious spending cuts and tax hikes. So they're just warning the Aussie market now, we're going to start reining in the fiscal. Now, meanwhile, when I say tax cuts, it won't be tax hikes most likely. It will be the winding back of some tax freebies. In particular, retirees, franking credits, I can see them tackling some of those, maybe capital gains tax. So they'll try and get back some of the tax breaks on housing.
These have been very tough subjects for them to get across the line.
If I were Labor, I'd say, why not? You've got government for 3 years, opposition, I don't know who the opposition is nowadays, they'll be in the wilderness for years, so this is your chance to do it. Now, the good thing about the government's plan is, meanwhile, every government around the world is massively indebted and racking up massive deficits, except Australia. We've had this monumental iron ore and now coal boom, so Australia's going to have a surplus, a trade surplus and probably a government surplus. It's got trade surpluses already, but the government debt surplus is going to be completely windfall again. Hopefully, I don't think they will be swayed into putting off their tax reforms because of that windfall gain, I suspect. So that's probably not a bad thing from a government point of view. It'd be easy to say, look, we're back in surplus, we don't need to worry about tax reform. I suspect they will say we still need to attack some of these crazy tax breaks on property and retirees and franking credits. Now, we're not making a view about whether they're right or wrong. We're saying the government's going to attack them. They tried, Kevin Rudd tried to attack it and failed, Bill Shorten tried to attack it and failed. Labor's going to say, we've got a mandate, there's no opposition, we've got Greens on our side, let's do it. We'll see in May. So Australia's been very well placed. Plus we've got the commodities boom, we've got the miners making bucket loads of money in Australia. The banks have done quite a good job. They've got low bad debts. Australia will probably survive a deep recession or be less deep than if we have a global recession next year.
The simplification of the bank model over the last few years back to being sort of, as you described, more credit union-like will probably serve
Banks
them well.
are basically overpaid, bloated credit unions with $10 million CEOs. Why we pay them $10 million, I have no idea. That's another story for another day.
Go easy on those CEOs, they really earn their money.
Yes, sort of.
So you probably paint a picture there of still reasonable caution, but valuations. I think there's anything you take away from it is valuations are not uniform across markets. There are areas where there's better value than other spots. Now we did spend a bit of time last month talking about the fairly sorry set of circumstances at FTX. And something I'm encouraging us to do more of is probably answering the client questions in these podcasts. So you address it in your paper. Is this a speed bump for the crypto revolution, or is this a beginning of the end, or somewhere in between?
It's when I started out in banking in 1983, a fellow in America in San Francisco called David Chaum wrote a paper which I read a couple of years later, and I thought this is going to change the world. So this crypto idea is 40 years old, not new. Didn't appear last year. It's a 40-year-old idea, and the idea is that banks have been around 500 years, but banks were unautomated and the database was not kept in a central place and searchable. Now, back 300 years ago, had your money, but they had no idea what you spent it on, and it was not recorded anywhere. In the 80s, banks started to introduce computers. So they started to introduce the idea of having to look at and be able to see all your transactions, who you're spending money on, where it's going, your lifestyle, your retailers, your habits. So from a privacy point of view, it started to get scary. Visa and MasterCard, who take all the payments in the world, they also were automated in the 80s, so they for the first time can actually see what you spent, where you spent it, what you spent it on. So this idea of a privacy...
You know more about you than you did yourself.
Exactly.
Yeah.
So did they use that sensibly? No, of course not. But the fact that they had this data and they had the power to use it was very scary to libertarians, and for good reason. So the idea was born in the 80s that maybe there was a better world outside this realm of prying eyes of banks and payment companies. At the same time, in the 82, you had the Latin debt crisis, where the government yet again bailed out the commercial banks in America and gave them money, and taxpayers bailed out the Citibank and the other big banks. So this idea that bank collapses and the banks were not being custodians of money and they were being bailed out by taxpayers all the time. So it was a very good idea to maybe have a world outside of banks, outside of central banks, outside government, outside national borders, outside tax laws. It's a libertarian sort of utopian space, free of all taxes and regulation and banks and central banks and government. So that was the idea, powerful idea. Will that idea go away? Hell no, that's gaining more power. Then you had bailout Wall Street, and then you had the GFC, and then you had the COVID, then you had the massive government debt, then you had all the bailout. So this is an idea which is even more powerful than it was in the 80s, the idea of getting away from banks, central regulations, governments. And then you had all of the developments through the 90s. You had the developments of the early B-cashes and the early sort of cryptocurrencies that were experimented with, ATMs, etc. And then you had the 90s, then you had the 2000s, and then you had the 2010s, and you had the big NFTs. And every one of these cycles has created more and more interest. But unfortunately, Bitcoin's been around since 2008, when this mysterious Japanese, possibly fellow, dumped the code on the web. The problem with the central idea is you've got this limited amount of money, Bitcoin, and you have a transaction record on a block, and every set of transactions recorded on another block which is attached to the previous block. So you've got this chain of blocks, which are distributed on computers all over the world, thousands of computers, not just one central hub. The problem with it was that in order to reward computer operators, people, from verifying transactions and certifying transactions, you had to pay them. And you paid them in form of a new Bitcoin that they could discover and be mined by solving a mathematical problem. And the coding is so good that no one's been able to break it so far, and probably NSA in America was responsible for the code set that created it, which is the biggest and best code crackers in the world. So it's not going to be broken, especially by them. So that's fine, except the idea that you had these tokens which are mined and given to people who maintain and build the blockchain, the chain of blocks of transaction history, and distribute it around the world. Good idea. The problem is you have to have these tokens, which by definition, if they're limited supply and people want them, the price is going to go up. So the idea of a currency based on a limited supply is a good one, but wherever you have lack of regulation, lack of scrutiny, lack of licensing, lack of insurance, lack of government guarantees, you're going to get fraud and theft. So around the world, particularly over the last 12 months with the free money from COVID, a lot of people developed exchanges, which are trading platforms in order for people to buy and sell and transact in cryptos, Bitcoin and 1,000 other cryptos. These exchanges, of which FTX was apparently the second largest in the world, if you wanted to go and buy Bitcoin, people have been asking me for years, how to go and buy Bitcoin? And the answer is, well, you've got to go and find an exchange, you've got to get a wallet, you've got to get a key. Who do you trust to give your money to as an exchange? The answer is nobody. There's no regulation, there's no licensing, there's no insurance, there's no government guarantee, there's no capital backing, there's no labour, there's nothing. So I wouldn't recommend
That's the vision of the whole thing.
And I've recommended, exactly. So the vision is a world outside regulation, outside scrutiny, outside auditors, so that's what you get. So a lot of people with the free money put money in all sorts of silly exchanges in Australia, mainly Queensland. Queensland, for some reason, is the home of Bitcoin, and Tasmania's got a couple. So I said to them, look, fine, do it with money you don't mind losing and never seeing again. It's play money. Never bet the house. Never put any serious money you want to. I've personally never trusted an exchange, and therefore I've never bought a Bitcoin or anything else, nor would I ever. But watching people get lured into these things, and they advertise, they got full-page ads on the papers, they sponsored all the sporting events last year, they were the biggest next big thing. People then fell for it and gave money to the exchanges. Now, where you've got money and where you've got a lack of scrutiny, you've got people are gullible and greedy. Human beings always have and always will be gullible and greedy. And wherever you've got money that's without scrutiny and unregulated, you've got gullible and greedy people on the other side taking it, and you're going to lose it. So there's no trust, there's no custody, there's no responsible entity, there's no auditors. It's basically money you give to some wallet somewhere in the world, mostly in a tax haven. You can't even find it if you tried. FTX was one of those. It's a speed bump. It's unfortunate. Lots of people, about 1 million creditors around the world, lost something like $10 billion US. About 30,000 Aussies had been lured into these funny schemes, and that's just one. In the same time, the last week, 2 others in Queensland have fallen over, and people have lost their money in small amounts. But FTX was big and ugly. And the
There's
funny
some
thing was,
major groups there, the Ontario Teachers Pension Fund, who unfortunately were one of the major shareholders in Enron. I sort of realised I was reading deeper into the story that fund has not had
a lot of pension funds were lured into it. A lot of sovereign wealth funds were lured into it. A lot of venture capital firms were lured into it. And I always scratch my head and say, well, show me where show me the audit trail I can actually find the money, and I'll look at it. But no one's ever given me that to date, and until they do, I won't invest a cent. But it's sad to see people lose money in the latest fad scam. There'll always be money lost in scams when there's greed and gullibility.
Yeah, and I think you've talked about it on the podcast previously. There's a lot of merit. There's a lot of things to like about the blockchain and the idea of those simultaneous settlements and things of that nature. But the coin, as you said, that became the byproduct of incentivizing people to create the blockchain is shouldn't really have been the main event, and has unfortunately ended up blowing up.
Yeah, the scary thing is that SBF. What's his name?
Yeah, Sam
Bankman-Fried. The scary thing is that, and I pull a couple of magazine covers in the story here. Australian Financial Review, which tries to be credible, when it once had journalists years and years ago, now it's owned by Channel 9. The AFR celebrated SBF Sam Bankman-Fried as the richest individual in the world under 40, 30-year-old worth $25 billion US. This is a month ago. Forbes magazine, which again pretends to be credible, Forbes magazine is the number one business-selling magazine in the world, in August had the front page story saying, is he the new Warren Buffett, with a picture of SBF's face. Barron magazine had the same thing, The Economist had the same thing. So the problem is that journos basically used to do research and actually check money where it is and how it's kept and where it's stored. Nowadays, journos don't do anything more than copy and paste, and they just make up these stories.
Actually, I will argue. One, there is plenty of good journalists, I think, still at the Fin Review, but not many of them. Not that many of them left, because it's sort of they're more and more thinly spread. But I'd say history doesn't repeat itself, but it rhymes. So I think Fortune
Yeah.
magazine had Enron as the world's most innovative company 7 years in a row.
One day before.
And the year of its collapse had also made it not just the most innovative company, but the best managed company. So
It was-
I think you might misty-eyed back to previous periods, but I
No,
think
no,
as you
not
said,
at all.
people
Not at all.
are gullible. People get excited by these stories,
It's-
and if something's going up at a exponential growth rate, it's
That's
hard
right.
not to look on and think, what am I missing here?
Yeah, no, look, I mean, you go back to tulips.
Yeah.
It's the same thing, South Sea bubble in
Yeah.
the 1720s. It's every era has a brand new idea. Most of it's based on the canal bubble and the railroad bubble. Most of it's based on a new technology which will change the world. Except tulips. Tulips are never going to save the world. But the dot-com era, the canal bubble, the railway
It's always
boom,
based on this time. It's different.
the nickel boom. It's always some new technology. This time it's different. Now, dot-coms had this massive boom 20 years ago. Some great things came out of that. Amazon came out of it. Apple came out of it. Microsoft conquered the world. But for every one of those, there's 1,000 others that fail. So I think Bitcoin or crypto, the idea is very powerful. It will last. People will keep working towards the ideal utopian aims. But in the meantime, there's going to be a lot of bubbles and bust along the way. And this, unfortunately, cost a lot of people a lot of money. But this year is going to go down as one of those, shares are down, bonds are down. But you did well if you avoided that sort of crap.
Yeah.
And we are very safe and sound and boring at times, and we don't get excited by these fads that they come along. We want to see where the money goes. We want to see the audit trail. We want to see how we can get the money out. We want to see lines of defence. We want to see protection. And only then will we start to invest, and we do it slowly. Unfortunately, a lot of people are much more loose with the money.
Yeah, and I guess it depends on your financial situation, and if you're happy to speculate and happy to lose
By all
capital
means,
on that,
have a go.
that is your prerogative. So thank you very much for that question, and I encourage your listeners to certainly send through more questions to your advisors that we will address in the podcast. To wrap us up, we finishing the year as you've just given us a recap in the year. How do you see 2023 as we world begins to normalise further?
Normalised COVID-wise, yes.
I'm guessing you normal back to the old normal of interest rates. A world where capital has a cost, valuations have a science behind them, and,
That's right.
and profits matter.
People will be digging out Graham and Dodd, which is every analyst in the world starts off with Graham and Dodd, which is I'll bring it in next time. I've got it annotated to death. I've got, I think, the 17th edition, 1980 odd, written 80 years ago, about how to value companies based on cash flows and book. People will start to do that again and start to actually buy companies based on real values, based on real cost of capital, which is a good thing. So I think 2023 will be a year where there'll be a lot of buying opportunities for sensible assets at sensible prices. And we look forward to that.
That is excellent. Well, let's finish on that note. And thank you to you, Ashley. Thank you to all our listeners. And we wish you all a very happy Christmas and look forward to speaking again in the new year. Thank you.
Fantastic.